So by that time, I had done a lot of research. The final tally of what I reviewed, I ended up doing 454 in-force illustrations on variable universal life policies. At the computed default rate of 8%, which is the rate that opens up when you go into the software as an advisor, 63% of them were lapsing despite making all payments, no loans, no current charges going to guaranteed maximum, earning 8%.
Okay, so just to
But when
clarify,
I
you're
had,
saying the software as a financial professional, insurance agent,
correct.
if I want to go work with Johnny or Susie who wants to buy a policy from me, I go to XYZ insurance company and I open up their software to build their proposal. All of the
Yep.
default options include what you just said.
Start at MetLife started at
Mhm.
8. That was the number that I saw. But I thought 8 was a stupid number. So when I moved it to 6%, 89% of them were crashing by age 95.
Mhm.
By the way, Jimmy Carter is 100 years old last
Yeah.
week. Okay. So 95 is nothing. I live in Boca Raton, Florida. That's 10 minutes north of Fort Lauderdale. November's coming around. That's when the snowbird season comes. Average age around here is 100 years old, like legit. Especially at 4 o'clock. If you ever want to eat early, you can forget about taking a seat there. And when I looked at the universal life policies, they were using current market rates, which were now 4%. I reviewed 552 of those and 94% of them lapsed.
At
So
so say
over
that again. So
90%,
at 4%? No, really?
yes,
The
because when
4% and they were lapsing?
remember, the universal life, which is in money market rates, were using money market rates at the time of purchase
Okay.
when it was 8, 10%.
Yeah,
But now when I was running these current in-force
I see.
illustrations, the current and
Yeah.
future projection, and the software was giving me
4.
4%
Okay.
because interest
Yeah.
rates were low,
Mm.
they were also crashing. So
Wow.
I had all of this detail. So I knew the average policy age when it was issued, the average policy age of the person buying it. I figured out ratios on what the average cash value is in the policy, the average cost per $100,000 of coverage. I knew the net at risk, net amount at risk. I knew everything about these policies. And this is 2016, so I was ignored. I kept on doing my research. And in 2018, I was like, oh, let me write a book.